Today, I'll be showing you hidden threats that are silently draining many retirees' 401k accounts. And over my years of helping clients manage their retirement accounts, I've watched these same silent killers repeatedly impact 401k performance in otherwise well-managed portfolios. That's exactly why I'm making this video today, to expose these hidden 401k threats before it has a chance to damage your retirement savings. Let's get right into it. I'm going to cover 3 hidden threats that are killing 401ks. The first hidden threat that I've seen damage 401ks, a lack of awareness on the taxation of 401ks, specifically when you pull money out of 401ks. A traditional 401k is a tax-deferred account. That means when you put the money in, you get a tax benefit, a tax deduction. It can lower your income that year. Your money, it's invested into stocks and bonds that are earning interest and dividends, and it's growing. And you're not actually getting taxed on that on a year-to-year basis. It's tax-deferred growth. But eventually, you will get taxed on that money because the government wants their tax revenue. And so when you pull that money out, now that money is taxable to you as ordinary income. However, if you pull this money out before age 59 and a half, there is a 10% penalty. Now, there is one exception to this penalty that I want to cover in this video that's really important, because I know some people who have specifically waited to age 59 and a half to retire to be able to pull money out of their 401k and avoid this 10% penalty. And they had no idea that you can actually pull money out at age 55 and separated from service without that 10% penalty. That is one benefit of a 401k over an IRA, and is a consideration on why you may not want to roll over a 401k to an IRA if you're planning for an early retirement, just so you can access those funds several years earlier without that tax penalty. The reality is that how Americans work has drastically changed over time. As Americans, we don't tend to work for the same company over 40 years. It seems like the modern trend is switching companies every couple of years. Part of the reason that this is because, these are estimations, but some data is showing that the average pay raise when you switch companies is close to 10%. And if you stay at your company, the average pay raise is only 3 to 5%. So there's this financial incentive that has drove thousands and thousands, millions of Americans to be switching jobs every several years to progress their career. And so what happens when you're doing this, you may be accumulating a ton of 401ks. And every time you leave a job and go to a new job, your old 401k sends you an email or a letter, and they say, hey, here are your options with your 401k. You can A, leave it where it is, or B, you can cash it out because you don't work here anymore. Alert, alert, if you do that, there is a tax consequence and likely a penalty if you're under age 55 and separated from service, or below age 59 and a half. Or C, they'll say, you can roll it over to your new 401k or an IRA. And for a lot of people, it makes sense to roll it over into your new 401k, right? It's just one less login to keep track of. It's one less statement that you're receiving. But for some people, it may make sense to roll it over to an IRA, right? Because they can self-manage it at Vanguard, Fidelity, Schwab, cheaper than they would be inside of a 401k, where you're paying for an advisor fee, a third-party administrator fee, record-keeping fees. And if you work with an advisor, in order for them to help you, they're going to ask that you roll over your money to an IRA. And there may be times where that may not make the most sense. Again, if you're trying to retire early and access these funds between age 55 and before age 59 and a half, you should probably leave it in a 401k to avoid that 10% penalty and still get access to it early. Another situation where it wouldn't make sense to roll it over to an IRA is if you're a high income earner and want to be making non-deductible contributions to your IRA and convert them to Roth. So you're using after-tax money to put it into your IRA. You can get deferred growth if you leave it in the IRA, but the real strategy is to convert it to Roth, so that way the growth is not just deferred, the growth is now tax-free when you pull it out. But the problem is if you have other IRA balances, this muddies the water, right? On Form 8606, where you report these conversions on your tax return every year, the formula makes you prorate all of your IRA balances. So you're not able to cherry pick the non-deductible, the after-tax money, and convert only that to Roth, right? So for people that are doing this strategy, typically called the backdoor Roth strategy, it makes a lot more sense to have your old 401ks roll into your new 401k. So that way you don't have any other IRA monies that are impacting the backdoor Roth contribution strategy. And if you have other money, right, in other types of taxable accounts, either after-tax Roth accounts or tax-free Roth accounts or HSA accounts and taxable accounts, you can absolutely control your taxable income based on which accounts you're pulling from in retirement. And there are advantages to doing this, especially if you're trying to get premium tax credits or subsidized healthcare before Medicare age 65. Timing and taxes is everything before and after retirement. Now, it's a lot to manage by yourself. That's why I make these videos, to make you aware and, to be a resource if you'd like to reach out. Timing in your investments is also another hidden threat that can kill your 401k. You're probably familiar with Warren Buffett. One of his most famous quotes is to be fearful when others are greedy and to be greedy when others are fearful, right? So when the market is up, we tend to be greedy and we want to buy because we hear about all these stories of everyone making money and we don't want to miss out on making this money. When the market's down, we tend to be scared and fearful and want to sell because we don't want to lose any more money because the pain of losing money hurts and we want to stop that, right? So the natural tendency, behavioral finance, right, would say that we're inclined to buy high and sell low. Well, if you repeat that enough times, you're going to end up broke, right? And so Warren Buffett is saying, well, let's flip that. Let's do the opposite. When everyone's greedy, let's be a little bit scared, and sell high. When everyone is scared and selling, well, let's buy low. Let's be greedy and buy low, right? And so if you buy low and sell high and you can do that consistently, now you're making money, right? And in fact, rebalancing your portfolio is one of the ways that you can do that. Systematically selling high and buying low. We need to have time horizons tied to our investments, right? We need to have a purpose and a plan for our money. Dedicate certain assets to certain goals because we don't know, it would make no sense to have your grocery money invested in the market because there's no guarantee that a week from now when you need that grocery money, it's going to be worth more than it is today, right? Markets can go down in value over short periods of time. But if this is long-term retirement money, then absolutely you can afford short-term market volatility because we expect returns higher than inflation long-term. And just that short-term volatility is the price that you paid. You're going up, but there are going to be ups and downs along the way, right? But the trend is definitely up. In many 401k plans, the default investment is a target date fund, which is actually a really good investment for accumulators. Because the research shows that most people set up their 401k and then they never look at it or change it ever again, right? So whatever their initial allocation is likely what their allocation is going to be years down the road just because we just don't check it and change it on average, right? Knowing that, well, how can we design good choice architecture that can use our inaction in our favor? So if we have a good default, like enrolling into your 401k plan, or a good default like auto-escalating your savings in your 401k, or a good default like a target date fund, knowing that we will likely experience in action when it comes to this account. How can we set people up on a good path? Well, the target date fund sets you up on a great path if you don't ever go back and change it because as you're young and need to take on more risk, it has more stocks, more exposure to stocks, more risk, higher expected return. As you're approaching retirement, it's dialing back that risk and introducing more bonds into your portfolio, right? So for an accumulator, it's a great, set it and forget it plan, and it's typically low cost and globally diversified. So yeah, I'm a fan of target date funds for accumulators, especially considering most people will set it up and then just forget about it. Where I'm not a fan of target date funds is for retirees, because a target date fund has stocks and bonds inside of it. And when you are now at the stage of life that you're turning your life savings into monthly paychecks, it does not make sense to sell stocks and bonds at the same time. You would rather have the tactical ability to sell stocks or bonds based on what the market is giving you, right? If the market's really low, well, you don't want to sell your stocks because you want them to recover, right? You don't want to lock in those losses on your stocks. You'd rather get the income from the bond side of your portfolio. And if the market's really high, that would be a good time that you could trim some of your stocks and lock in some of those gains and use that money to fund your income. In retirement, it pays to have your stocks and your bonds not inside the same fund so that you can be more tactical based on what the market's giving you, right? So again, at this point in the video, I've covered 2 of the 3 hidden threats that can erode or kill 401k balances: timing in regards to taxation, timing in regards to investing. Now that you understand how critical timing is for your retirement success, you need to realize that this goes beyond just basic 401k planning. It's about creating a complete strategy that works for your specific specific situation. And even though videos like this are great for understanding retirement concepts, what's most important is knowing how these insights apply to your unique circumstances. And that's exactly why I'm offering a complimentary call, where I'll show you exactly how to optimize your retirement plan. Just click the link below to schedule your call. Now back to the video. The last risk that I want to cover in regards to your 401k is the ability to borrow from your 401k. Not every 401k is set up this way, right? Every 401k has a plan document that can be slightly different, but it's not uncommon that people can borrow from their 401ks. And what they don't realize is that when they are borrowing from themselves, they're really interrupting long-term compound growth and borrowing from their future self. And it can just be detrimental to the long-term growth and compounding of your 401k. I get it. Life happens. Sometimes you have to access retirement funds early, and thankfully there are some of these provisions in here that can help you when you are in a hardship. However, what I would say is think back to the financial order of operations, right? So if you remember the math order of operations, please excuse my dear Aunt Sally. If we were to put that into the finance world and think about, what to do with your next dollars, and in particular, how to prioritize long-term growth, well, then before we're investing and compounding for long-term growth, the first step is to make sure we have cash on the sideline and building up an emergency fund. The reality is most Americans don't have an emergency fund. After you have an emergency fund established, now we can start thinking about maximizing your employer match and paying off high interest credit card debt, and then taking advantage of the most tax advantage accounts, HSAs and Roth IRAs. And now we're thinking, okay, now I can start contributing more to maxing out my retirement accounts, my 401k. I hope you found this video helpful. I hope that now you're at least aware of some of these hidden threats in regards to timing of taxation, timing of your investments, and even borrowing from your 401k and how that can interrupt compound growth. Before we wrap up, through analyzing thousands of retirement plans, I've discovered that even diligent savers who follow conventional wisdom are often completely unprotected from these threats. The most secure retirees I work with aren't just diligent savers, they're actively protecting their 401k from these overlooked risks. I can appreciate it can be difficult to understand how to do this yourself, so if you want some help understanding your retirement plan and specifically how to manage your 401k, click the first link in the description and book a complimentary call with me. We'll run through your retirement plan, much more. I'll see you in the next one.